Job order costing is appropriate when you're making just a couple items and they're different products, right? Versus process costing, where everything is most of the products are identical and indistinguishable. And so a lot of times you can think of job order costing, maybe we're making different batches of this or that. So this chapter or this slideshow we're going through here talks about, or in the book talks about making guitars, maybe a custom guitar, maybe a cruise ship or something like that. That's a huge job, isn't it? Then most of those cruise ships are different. They are distinguishable. Versus process costing would be good for something like creating, manufacturing toilet paper rolls or number 2 pencils or something like that. So in this case, you can see it produces many units of a single product. Okay, and in this case, we would worry about computing cost by department. This is not the focus of this chapter, though, so we'll get back to job order costing. So this is a job cost sheet here in example 1, and what this does, we're going to see, this is where we're going to keep track of all the cost related to a different job or to a particular job. We have these different job numbers that are specific. It's a unique identifier to this one job. As you can see down here at the bottom, we're going to tally up direct materials, direct labor, and manufacturing overhead. And based on that, once we've accumulated all the information here, we're able to see the total cost and the unit product cost. So in this case, we have Pear Company's example when they go on and request some materials, and it's $116 worth of materials that they need. And so they're going to go ahead and put those guys into service. And so remember, we have inventory is going to be classified in 3 different ways here with the manufacturer. We're going to have our raw materials, which have not been placed in service. So you can think of those as like a whole bunch of wood in maybe a supply shed or a material shed. And once we place those materials into process, they become work in process inventory. And they're going to stay in work in process until we're finished, and then they become our finished goods inventory, which are ready to be sold. So we can see here in this case we have $116, and it's going to be accumulated right here. And next thing we're going to have to worry about is our labor. Okay? So the labor here, we can see it took 8 hours to work on this, and at an hourly rate of $11. So 8 times 11 gives us 88, and that's for job A143. So we come back here and we put the 88 there. This hasn't been too complicated up to this point, and it's really not too terribly bad, but it's going to get a little bit different when we have to start figuring out how much overhead to assign to this. So how would we know what to assign to a product? Factory overhead is something that can be a little more tricky, and we have no idea what the actual expenses are going to be throughout the entire year. We have no idea what property taxes are going to be necessarily, or the electricity bill to keep the lights on in the building. We just don't know. We can get a pretty good estimate, can't we? We might look at something like the last year's expenses, or we'll use different things and different methods to come up with a good estimate. And so what we're going to have to do is come up with a predetermined overhead rate. And so basically what this is we're going to estimate the total costs that we're going to have over the year, and we're going to divide that by the total cost of direct labor hours or whatever else we feel is a good way to allocate that overhead. And so what we're going to do then, we're going to come up with a rate. Maybe it's $5, $6 per direct labor hour, and whatever it happens to end up being, and we're going to multiply that by the actual numbers of direct labor per job. Okay, the cost driver in that example would be direct labor. So it says at the end of the accounting period, once we learn what the total of actual overhead charges end up being, we're going to make an adjustment to adjust our estimate to what it actually was. So we're going to give it our best, we're going to estimate it, and we're going to wait, and we're going to have to wait till we know what the expenses actually are, and at that point we're going to adjust those two to make the estimate equal to the actual. Okay, and here's a couple reasons why. Feel free to pause the slide here if you like to see here, but there's a lot of different reasons that we need to use this predetermined overhead rate, and the main thing is we don't know what the expenses are actually going to be until the end of the period. So like I said before, the estimated total cost divided by the estimated total units in the allocation base. And it says ideally the allocation base should be a cost driver. That is, it causes overhead to be incurred. So once we know what that predetermined overhead rate is, we just simply multiply it by the actual activity. And overhead is most commonly applied at the end of a job, but it may be applied periodically while work is being done as well. So let's take a look at this example here. And we have some figures here that are based on management's estimates. These are just given to us. And we think we're going to have a total of $640,000 of overhead cost, and $160,000 is the estimated amount of direct labor hours that we believe we're going to have. So when we divide those two together, we come up with $4 per direct labor hour. Okay? So now we see here, it looks like a little smiley face, doesn't it? See here that we had 8 direct labor hours, okay, and $4 is what we said our predetermined overhead rate is, so that's no problem. 8 times 4 is 32, and we plug that number in right down here. So now we have $116 of materials, $88 of labor, and manufacturing overhead of $32. We add those all up and we get a total of $236. But look, this was to complete 2 units. So because that's the case, we're going to divide 236 by 2, and that gives us our 118. Here's a little, feel free to pause the screen here and test your knowledge. You should have gotten $730. Okay, so what would an accounting class be without some good old-fashioned journal entries? We're going to talk about some of the journal entries that are going to be necessary here to record the flow of cost through a manufacturing cost system. And what we're going to see here, the first thing we're going to do is make a journal entry to show that we've purchased these materials. So we're going to increase that purchase with a debit. And we're going to have an increase to a liability here. Since in this example, I guess we're assuming that we're going to pay for it later. If we paid for it right away, it would have been totally fine to have credited cash to show the cash outflow. When we place those raw materials into service, we're going to reduce this account here, and we're going to increase, this is an asset here, right, and it's going to go down. And now we're looking at the other inventory account, which is work in process. So this is basically what happened, right? So we purchased materials, and then when we placed them into process, we're going to show the reduction here and the increase there. Materials are called raw materials before they're placed in service, and then once they're in service, we refer to them as direct materials. This is what the entry might look like to show that we're incurring expenses with relation to people doing work, salaries and wages, right? So work in process, once again, this is an inventory account. This is different. We didn't expense this amount right away, did we? Instead, it's being lumped in with inventory, and only after the product is sold will we be able to write that off. So now you can see here we're accumulating direct materials, direct labor. Next thing is going to be overhead. Now remember, we're going to incur actual amounts of overhead throughout the year, and when we do that, we're going to debit manufacturing overhead and credit whatever we need to be our offset. So we're going to have actual, and we're going to have the amount that we're going to apply using our predetermined overhead rate. Okay, so actual is going to be on the left, and the applied amount, our estimate amount, is going to be on the right. At the very end, we're going to look and see what the difference is, and we're going to have to make a journal entry to make those two guys zero out so that there's no difference between the estimated or applied amount and what the actual amount is. Okay? So here, this would be an example of when we are applying the manufacturing overhead using the predetermined overhead rate. We're going to debit work in process, and we're going to credit manufacturing overhead. So we're going to add here, so we have direct materials, direct labor, and now overhead. And you can see here we have the actual cost and we have the applied, and we're going to have to see what the differences would be. Of course, there are going to be non-manufacturing costs that are incurred, and it's important to remember that these guys are simply going to be expensed. These are period costs, right? They're going to be expensed right away. They're not going to end up in inventory with the product costs. When jobs are complete, we need to reduce the work in process inventory account and push those guys on into the finished goods inventory account. This is where they're going to stay until they're actually sold. Once they're sold, we're going to reduce this asset, finished goods, and we're going to go on up here and increase this expense, which hurts our equity with the debit. We're also going to record the sale. And like I said, it might be a year, 2, 3, 4, or it might just be a couple days before we actually sell those finished goods. So what if actual and applied overhead are not equal? In that case, we're either going to have underapplied or overapplied overhead costs. So we can see here if the actual is greater than the amount that we estimated, we've underapplied. We didn't estimate, our estimate fell short. And in this case here, if it's overapplied, we overestimated. Excuse me. So let's take a look at this example here, and we're just going to pretend that the actual overhead for this pear company happened to end up being $650,000. That's based on what was actually incurred. And if we figured out, remember we had a $4 predetermined overhead rate, we had a total of 170,000 direct labor hours that was given to us. So we're looking at, we would have applied $680,000 based on that at the end of the accounting period here, or whenever we decided to apply it. So we assigned $680,000. This is based on all the different jobs in total, but guess what? It was really only $650,000. That means that we have overapplied. Okay, there's a $30,000 amount that we overapplied. So there's two choices here. We're going to take the easy method here in this book here. And this is what we assume. We can do this and it's okay as long as the amount is immaterial or not significant. And instead of having to split it between work in process, finished goods, and this expense here, we're just going to send it all to cost of goods sold. This method, of course, is less complex and it's easier for you guys to remember how to do it, but it's a little bit less accurate. So let's take a look here at what the journal entry will look like if it's over applied. So we're going to have a $30,000 debit to manufacturing overhead and a $30,000 credit to cost of goods sold. So basically we had sent too much to cost of goods sold in terms of lumping all those amounts in there. We assigned it too much factory overhead. So this is going to help to offset that. And remember, this method can only be used if the amount is insignificant. So in here we can see the difference between those two. There's a $30,000 balance over here. That means that this is our estimated side, so we estimated more than what we actually had. So we need to offset it with $30,000 here. Once we do that, these two are going to net out to equal 0. As a part of debiting this, our offsetting credit is going to go to cost of goods sold.